Hello everyone and welcome back to our channel. Today we are going to dive into the fundamental building blocks of accounting, which is journal entries. If you have ever felt confused by debits and credits, you are basically in the right place. Today we are going to break down the golden rules of accounting and making journal entries simple and straightforward. Okay, let's just get started. Journal entries basically are the very first step in recording financial transactions. They are like the diary of your business's financial activities. Now, every single transaction, let that be from say paying rent, receiving payments, all of these are recorded as a journal entry. And accurate journal entries are essential because they form the basis for all your financial statements. And without them, your financial reports would be unreliable and misleading. Okay. Now, let's basically talk about the foundation of accounting, the golden rules based on which all these journal entries are written. Okay. Now, if you want to delve deep into golden rules, we have already prepared a special video only on the golden rules in our previous video. You can actually watch that. Okay. Now, let's talk about the golden rules of accounting in a brief, because these rules are the foundation for writing correct journal entries, as I mentioned, and these are the three main rules, each for a different type of account. Now, personal accounts they involve people and organization. Real accounts, they involve assets and liabilities. Nominal account, they involve revenues, expenses, losses and gains. And what are the golden rules? If you remember, for the personal account, debit the receiver, credit the giver. For real account, debit what comes in, credit what goes out. For nominal account, debit all expenses or losses, credit all incomes or gains. Please remember, these are the most important rules. If you are gonna be an accountant, this is exactly what you'll be using throughout your life. Okay. Personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses or losses, credit all incomes or gains. Okay. Now, journal entry. Okay. Now, this is basically how a journal entry would look. This is the format of the journal entry. Okay. Now, if you look at it, basically, the first thing you'll write the date on which the transaction has happened, not when it was recorded. Okay, there are a lot of accountants who basically do weekly work or monthly work. Okay, but if he is writing an account book on say 30th for all the whole month, he won't write the date 30th of that month. Okay, on the day in which he is recording, the date is the date of the transaction. Okay, on which the transaction took place, that is the date. Particulars, in particulars we basically write which accounts are affected. Okay, now the accounts affected could be real account, nominal account or personal account, and a brief details of or narration of the transaction, just to understand why this is recorded, what is this transaction, just a brief description is written there. Then LF is ledger folio. Once you write a journal entry, these entries are basically transferred to a ledger, which we'll explain later in our next upcoming videos. Now, in a ledger, you basically transfer these in a ledger in a specific page number. Now, those page numbers have to mention here. That is ledger folio. Okay. Next, debit. Debit is the amount to be debited. Whatever accounts are being affected, the amount to be debited, and credit is similarly the amount to be credited. Now, one thing you need to remember while writing a journal entry, whenever you are writing a journal entry, make sure, okay, debit all or equal to credit. Debit equals to credit. The rule has to be followed. Debit should always equal the total credit. Total debit equals to total credit. Okay. Now let's take an example. Okay, let's take an example of personal account first. Let's take a transaction. First example is paid 5,000 to Ram on 1st April 2025. Okay, now if you look at the transaction, try to understand the transaction, try to understand what is the transaction and what parties or what accounts are being affected by it. Now what is happening? Paid 5,000 to Ram, okay. Now there are two parties involved there. Cash is paid, two accounts involved there. Cash is paid and Ram has received the account, the cash. Okay, so there are two parties involved in the transaction. What is happening? Paid 5,000 rupees to Ram. Okay, now two accounts are involved there. One is Ram, one is cash. Now if you take Ram, in what account, what type of accounts will Ram fall? Personal account, right? Not real account or nominal account. Ram falls in personal account. Now in personal account, what are the rules? Debit the receiver, credit the giver. Okay, so Ram is the receiver. We paid cash to Ram, so Ram is the receiver. So Ram account should be debited, that is debit the receiver. So Ram will be debited at 5,000. Next, the second part which is involved there in the transaction is cash. Now what is cash? In which account, type of account that cash fall in? Cash is not a personal account, cash is not a nominal account, cash is a real account. Very good. Now in real account, what are the golden rule? Debit what comes in, credit what goes out. Debit what comes in, credit what goes out. So what is going out? What is happening to cash? Cash is going out. So credit what goes out. So cash is going out. So cash account should be created, right? So debit and credit should be equal. 5,000, 5,000. Ram account, personal account is debited because he is the receiver. Cash account is a real account, credited because cash is going out. And in that, after the entry, we need a brief narration. Being cash paid to Ram. Okay, that's a simple example. Let's take another example for personal account. Okay, now received 10,000 from Sham. Again, look at the transaction. What is happening in the transaction? We are receiving, the business is receiving 10,000 rupees cash from Sham. What is happening? What are the accounts involved there? Cash. I am receiving cash and Sham, from Sham. Two, right? So cash and Sham. Now cash account. What is cash account? Real account. Very good. Now cash is a real account. Now in real account, what are the golden rules? Debit what comes in, credit what goes out, right? So cash account is debited. Sham account. Now what is the Sham account? What type of account is Sham account? Real account, personal account, nominal account? Personal account. Very good. Now Sham. Now in personal account, what are the rule? Very good. Debit the receiver, credit the giver. Okay, so credit the giver. Sham account is credited. Again, look at it. Credit is a debit is also 10,000. Credit is also 10,000. So debit should equal to credit. Total number of debits, total amount, total transaction in debit and total transaction in credit should always be equal in a journal entry. And after the journal entry, we wrote narration, being cash received from Sham. Okay, that's about the personal account. Let's look at the real account. Okay, now real accounts basically deals with all assets and liabilities. Now the transaction is purchased furniture for 20,000. Okay, now that is the transaction. Okay, now if you look, if you just look at the transaction, okay, what are the accounts involved there? What are the accounts involved? Purchasing furniture. Furniture is coming in, cash is going out, 20,000. Okay, and in real account, what is the golden rule? Debit what comes in, credit what goes out. So here both are real account. Furniture is also a real account, cash is also a real account, right? So furniture account debited 20,000, cash account credited 20,000. In narration, furniture purchase for cash. Both debit and credit are equal. Simple. Very good. Let's go for the second example. Sold machinery for 15,000. Okay, again, in the transaction, if you just analyze the transaction, machinery sold, machinery is going out, machinery account is affected, and cash is received. Now what type of account is machinery account? Real account. What type of account is cash account? Real account. Okay, the machinery account. Let's think about machinery account. Now what is happening with machinery? Is going out. So what is the rule of the real account? Very good. Debit what comes in, credit what goes out. Okay, so machinery account, credit 15,000. And what is coming in? Cash. Cash account, debit 15,000. Okay, it's very simple, right? If you understand the golden rules, analyze the transaction, accountancy journal entries are very simple. Okay, right. Let's take nominal account in action. Nominal account are basically all your expenses, incomes, gains, losses, etc. Okay, now the transaction here is paid rent of 12,000. Again, analyze the transaction. Paid rent. So paid. So cash is going out. Number one. What for it is paid? Rent. So rent is a expense, is a nominal account. Right? Cash is asset, real account. Okay. Now rent is an expense. So what happens there in nominal account? Debit all expenses. Very good. Rent is paid as 12,000 debit. Cash account. Cash account is real account. What is happening with cash? Going out. So credit what goes out. Cash is going out. So cash account credit. So rent account data to cash account, being rent paid 12,000. Again look, date, particulars, debit and credit should be equal. Right? Very good. Fantastic. Now let's take second example. Received interest of 1,450. Now interest received. There are in the transaction, if you analyze, there are two things happening there. I have received an interest. Okay, interest received. Now interest received is falls under what account? What is interest received? Income. Very good. Interest received is income. Income is what type of account? Nominal account. Very good. Now when it's nominal account, what are the rules for nominal account? Debit all expenses, credit all incomes. Okay, so interest received is credited. And what is, when I am receiving interest, what is received? Cash. Cash is real account. Cash is coming in. Very good. So debit what comes in? So cash account debit, interest received account credit. In the narration, being interest received. Okay, now this is nominal account. Now let's actually do a simple, a little complex thing. So instead of one type of account involved and two types of account involved, let us actually take a transaction where 3 or more accounts are involved. Okay, now for example, I started a business with 70,000 rupees cash and 30,000 rupees furniture. Okay, so now I'm starting a new business. When I'm starting a new business, I have invested 70,000 cash and a furniture which was already there, which was bought for 30,000. So I have given 30,000 furniture. So the transaction is started business with 70,000 cash and 30,000 furniture. What accounts are involved there? Number one, cash is coming in 70,000. Very good. Furniture is also coming in 30,000. Very good. Okay. And what is actually, who is given it? Who is given it? The owner. Owner is given it. Okay. There are 3 accounts involved. Owner invested 70,000 cash, 30,000 in furniture. Furniture's value is 30,000. Yeah. And owner. These are the 3 accounts involved. Okay. Now initially let's think about furniture and cash. Cash is come in. Very good. Furniture has come in. Very good. Now these are what accounts? Real accounts. These are assets. So debit what comes in? Cash coming in 70,000, furniture coming in 30,000. And who gave it? The owner. When owner is giving money, investing money in his own business, it is called capital. Okay. Now capital, if you remember the definition, the meanings of capital in our first video, capital means owner's investment in the business, in his own business. That is called capital. It's a personal account. Okay. So capital account will be credited. Okay. Credit the giver. Owner's capital account is giver. Okay. Now this is exactly how you write the journal entries. Okay. Now remember this. Let me have a water. Okay. Now remember this. To master all these journal entries, you have to remember these tips. You have to follow these tips. Identify what accounts are involved. Okay. Determine the type of account. The first is analyze the account, analyze the transaction and find how many accounts are involved. Okay. Then determine the type of accounts, personal, real or nominal. Okay. Then apply the appropriate golden rule. All the rules you remember. If you don't, repeat it again and again, you'll remember them. Okay. Apply the appropriate golden rule. Then ensure that debit and credit are both equal. Okay. That is the fundamental rule as well. In a journal entry, debit should equal to credit. And then write a clear narration so that when someone is reading it, he will basically understand what happened. Okay. Then practice regularly. This is the most important thing. The more times you practice, the more practice you do for journal entries, the perfect you will be. Okay. If you have any questions, please leave them in the comments. Don't forget to like this video and subscribe for more accounting tips. Thank you for watching. And that's it for today's video. I hope you now have a better understanding of journal entries and the golden rules of accounting. Okay. Now stay tuned for more accounting TV tutorials. See you next time. Bye.